There's also a growing chorus on the benefits of direct listings as an alternative to an IPO. That tune being largely led by venture capitalist Bill Gurley of Benchmark. He is said to have planted the idea with Slack CEO Stuart Butterfield, which listed in June. Spotify led the direct listing trend in 2018, and so far Airbnb has indicated it is also leaning towards a direct stock listing next year. I caught up with New York Stock Exchange President Stacey Cunningham earlier Monday on these topics.
If you take a step back and you think about why companies choose to go public, there are typically four reasons. One is access to capital so that they can raise some money. Two is having the credibility of a public listing and the visibility of that event. The third is liquidity for early investors and their employees who very often have been getting paid in shares or options of stock and want to be able to use that and go buy a house. Four is currency so they can engage in M&A. Now, traditionally, access to capital has really been the primary driver in raising money. And what we're seeing now is for many companies, because they're much larger companies and in the private market space, it's more the liquidity for their employees that's driving the public listing. So that allows you to ask yourself, can we decouple capital raising from a public offering? And that's what Spotify really started. Barry McCarthy, the CFO of Spotify, asked that question. He said, why do I need to go with the traditional IPO method if I'm not actually looking to raise money? And so that was really the genesis of the direct listing.
How does your role change between a direct listing and an IPO?
Our role, we've been at this for 227 years. We've been helping companies come to market so they have access to capital for a very long time. The IPO mechanism that we all talk about so much and are so familiar with has really only been around since the early 70s. So that doesn't change really our job. Our job is to help find price. We are uniquely positioned to do that at the New York Stock Exchange because we have a market maker that's assigned to trading each one of these securities. So with the direct listing, they're looking for that opening price in the morning to establish what the value of the company is and where supply meets demand. And so that's the job we do here every day.
And you are in San Francisco because you're attending meetings and conferences about direct listings. In your conversations, what do you hear from underwriters who it used to be profitable to help underwrite an IPO. Now they're trying to get more involved in direct listings. What do you hear from those conversations about how they're trying to get more involved in direct listings?
I think they're trying to serve their customers. And as their customers' needs have changed, the banks are looking at how they can be helpful and provide resources to their customers. So they're very engaged on the process. And you know, we've seen them take a real leadership position on how we can use this as an additional tool, an additional product they can offer their customers. And that's what we're seeing happen.
You had said that you recently are getting more tech companies on the NYSE, which previously they were listing on the NASDAQ because you modernized your rules and you allowed non-profitable companies to list. But was that a good decision? Do you consider yourself perhaps maybe an enabler in some of those unprofitable companies?
Yeah, I think many people don't realize that the New York Stock Exchange listing standards didn't allow companies that were pre-profitable to list on the exchange. And many of today's companies over the past several years have come to the public markets prior to being profitable. And so we modernized our listing standards. And since then, the vast majority of tech proceeds have actually been raised on the New York Stock Exchange as a result. But the question that you're getting at is, are those companies good for the market? And it's very important for a company, it's not unusual for them to be pre-profitability when they list, but then have a pathway to profitability. What's their plan? How are they going to get there? And investors can share in that process, and ultimately they do become profitable. And we've seen that with tons of companies out there.
Quickly, finally here, how has WeWork changed the market?
I think there's a conversation. I'm never going to talk about specific companies, but there are conversations that the market is having around discipline and governance in companies, around the valuations of private markets versus public markets. And this is not it's not a story about one specific company. It's a story about trends we're seeing in the market. When there are fewer investors determining the valuation of a company, it's not price discovery like we see in the public markets where you have many, many investors. Nobody can value. There are tons of smart people in the private market space. Nobody can value a company the way the public market does. And that's real value that the public markets give to investors and employees and all Main Street investors as well.